Most people think you can only make money from stock when prices go up. What if I told you some stocks pays cash regularly, even if price doesn't move up or down? Yes, you can literally get paid just for owning the stock. Let's talk about dividends. When beginners start investing or when they enter into investing, they believe that it's only one thing that is going to help them make money: buy low and sell high. But there is another powerful way investors use to make money: dividends. And surprisingly, many people don't know how it works. By the end of this video, you understand why companies pay dividend to investors and how you are going to receive your dividend should a company pay dividend to you. Now let's dive in deeper. What is dividend? Dividend is simply a portion of a company's profit that is being shared to shareholders or investors. If a company makes money, they decide to share some of the profit to investors or shareholders. So if you own the stock, you get paid. Let's say you buy shares of a company, for example, MTN, because that's the most common share that a lot of people know about. So let's use it to do this example. MTN make billions or trillions of profits. Instead of keeping all the money, they distribute some to shareholders. So if MTN declares dividend, you get paid. Even if the price doesn't move up or down, you probably get paid. How do you actually get paid? If you own shares before the payment date, the money will be deposited into your brokerage account. It depends on the broker that you are using. Some will pay into your mobile money account, others will pay into the linked bank account or even your trade life account, because I know for other brokers that do such. Now, the reason why we are saying that before the payment date is this: companies have qualifying dates. So if you don't own the stock before the qualifying date, you don't qualify to earn dividend. So should you buy stocks before the qualifying date, that means you qualify to earn dividend. But when you buy after qualifying date, you will not be paid dividend. Nambex example. Let's break this down. Let's say you own 1,000 shares of a company. The company declares that they are going to pay 50 pesos per share. What happens? You get 1,000 times the 50 pesos that they promised to pay you. That's 500 cedis. Key insights. Notice something important here. You didn't sell your stock. You didn't trade it. You didn't guess the market movement. You simply held the stock and you got paid. That's very good. Now let's talk about why do companies pay dividend. They pay dividend usually because they are profitable, they are financially stable, they want to reward investors. Dividend paying companies are often mature and strong businesses. If the business have no matured grounds, they can't pay dividends. Because when you go to the stock market, there are a lot of companies that don't pay dividend at all. Others do pay twice a year, thrice, and some can even go up to 4 times in a year. So it depends on management discipline of that company. Now let's talk about price versus dividend. There are two ways to make money from stocks. Yes, there are two ways. The first one is capital gains or price appreciation. Let's say you buy a stock at 5 Ghana cedis, it rises to let's say 10 cedis and you sell. The 5 CD increments is called price appreciation or capital gains. And the second one is dividend. That's what we are really talking about. You buy the stock, you hold it, you get paid, you repeat the same process. And you can use that as a passive income, because I know a lot of people who are earning dividends as passive income. Smart investors use both. They don't only talk about price appreciation, they use both. They look for a company that pays dividend and a company that is going to grow so that they can grow their portfolio. You always have to balance your portfolio or diversify your portfolio. You don't have to put all your money into one sector or one business. You have to always diversify. So you can go in for dividend paying companies and companies that you believe they are going to perform well so that you can also sell to earn as price appreciation. Let's take this powerful example. Imagine this strategy. You build a portfolio in stock markets that can earn you a dividend of, let's say, 2,000 Ghana cedis a year in dividends. Then let's say as time goes on, you are able to grow that portfolio to 5,000 dividend per year or to even 10,000. Eventually, your investment starts covering expenses. That's how passive income is built. Always check for this: company stability, profits consistency, and debt level. I've told you that always check for the company's past history. Although past history doesn't guarantee that maybe the future they're going to perform more, but it tells you how disciplined the company is or how disciplined the management of that company is. Why dividends are powerful. Dividends provide cash flow, passive income, psychological comfort, compounding power, and less stress than trading. Wealth building mindset. Most beginners chase fast gains, hype stocks, quick money. Experienced investors don't do that. They chase cash flow machines, dividend portfolios, long term compounding wealth. If you found this helpful, drop a like, subscribe to this channel, and also share to people or friends who also want to know much about dividends and investing. Because over here, we are always providing you with financial tips and financial education. And tell me in the comment section, would you rather earn dividends or trade stocks?